How's it going out there? It's June 16th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Remember when nobody cared about inflation? I'm talking just a few months ago. We saw the data, the CPI, the PPI, which is Consumer Price Index, Producer Price Index, wages, rising labor shortage, chip shortage, everyone raising prices, everyone. I mean, nobody cared. It's like talking about uranium from like 2012 to 2018. Nobody cared. Uranium, what's uranium? We still use that for electricity, really? There's publicly traded companies outside of Cameco that I can buy? Everybody hates uranium. Now I do uranium videos, and they're the most watched. Everybody loves uranium, even though it's pulled back a little bit, which is okay. Because weird as pulling back, though prices are going higher. But it's been up incredibly. But it's like, talking about inflation, it was uranium. Nobody cared. Nobody cared. But over the past 2 weeks alone, holy shit. I mean, everyone is talking about inflation. It's a top story across all financial sites. You can look for yourself. They always list the top stories. Everywhere. It's everywhere. Why? Because consumer prices, the CPI, are now at 25-year highs. That's the CPI, guys. The gauge is created by our government to basically never show inflation. Well, now it is. The PPI, the Producer Price Index, rose by its highest amount. This is year over year, not just 1 year, 2 year, 4 years, ever, since they've been keeping track of this, ever. Are you surprised at this? You shouldn't be. I mean, it's a direct reflection. Commodities, look what commodities are. Look at the cost of housing. The cost of everything is going higher because materials are much higher. Why are we surprised at this? Even in China, did you see the data? Inflation, 12-year highs. We're going to see this in Europe as the rest of Asia. Europe, they're going to open up from COVID. Wait, explosion in inflation. They're going to see the same thing. And now, over the past week, some pretty powerful people have come up talking about it. And you look at Jeffrey Gundlach, who's came out and said, don't count on inflation being transitory or brief. And Jeffrey's a pretty important guy, known as the Bond King. He's a billionaire, manages a cool $135 billion through his firm, Praetorian Capital. Then Jamie Dimon, CEO of JP Morgan, another pretty important person. He came out. So JP Morgan is hoarding cash right now because inflation, and I'm quoting, is here to stay. It's a pretty big statement considering he is the head of JP Morgan, and what do they manage these days? $2.5–3 trillion? Then we had Paul Tudor Jones coming out of the woodwork. Doing a pretty cool interview on CNBC saying go all in on the inflation trade as the Fed keeps ignoring higher prices, and they are. They're ignoring higher prices. Paul Tudor Jones, and not one of the hedge fund managers that's mentioned often in the media, but very, very important guy, legendary, billionaire. I think he has something like $45 billion in assets under management in Tudor Investment Corp. Now, there's something these guys have in common. Other than being filthy rich, pretty smart, and we all kind of wish we were at that level. They're all old dogs. Meaning, they remember the last time we saw inflation in the 80s. They lived through it. Most of these guys were managing money during this period, and it was double-digit inflation, and it was scary. It was really scary. You look at double-digit inflation, which, by the way, Kyle Bass just came out, I think it was yesterday on CNBC, saying if you use a non-chain weighted index, inflation right now is at 12%. That's 80s. 12%. What does that mean, non-chain weighted? The Fed currently uses a chain-weighted CPI. Again, it's a way to mask inflation. So it accounts for the fact consumers' purchasing decisions, they change along with the changes in prices, as opposed to merely measuring the regular changes in price of a fixed basket of goods. That's the textbook. What that means is, we're going to use a chain-based index because it's always going to show lower inflation. He said, don't use a chain, right? Because all of our costs across the board are higher. Why are we eliminating certain things? Why do we exclude food and energy? Why? We don't pay those prices? Really? That's what we want to do. We want to mask the inflation and make sure it doesn't look that bad, because it is that bad. Now, why are these guys sounding the alarm? Because they understand the only way out of this mess is ugly. It's to force a recession. I mean, it's not going to be pretty. It's not fun when you're pulling a rug out from everyone, shrinking their wallets, making it incredibly difficult to borrow money. I mean, how easy is it to borrow money these days? Doesn't matter how much debt you have. They keep, hey, you're fine. Go ahead. Low interest rates. But during these times, you can see unemployment usually goes up as tons of businesses begin laying off people. See rates go higher. See lots of bankruptcies. How many companies, especially the model of the past 5-10 years, has been take out as much debt as you can. We just want to see the numbers grow. Even Disney adopted that model. We don't care about the numbers. One of the few companies you're not going to see numbers go back to pre-COVID levels probably for another 2 years, because they gave away a streaming service for free and said everybody wants to see the numbers, and that pushed their stock to all-time highs, and they raised money. Good for them. The model worked. That model's really dangerous when you're sitting on massive debt piles and you're a roll-up company, which is, a great strategy with low interest rates, right? You're using your stock as currency to purchase other smaller names and build a huge company, right? So you're acquiring, using the debt markets. These guys are incredibly talented using leverage. And good. Oracle is a perfect example of the roll-up. That's there's just a bunch of software companies they put together and integrated. AutoNation's another one, but these guys get destroyed when it doesn't work out. DXC Technology was a former holding. We stopped at it. We learned that. It was a roll-up, and they got destroyed for a while. But it kills a lot of these companies. Think of the ESG companies that aren't expected to generate money forever. Forever. Now you got high interest rates, and you're borrowing. It impacts so many companies. We're going to see asset prices deflate since higher rates cause less spending, especially discretionary spending. Because in America, we love buying stupid shit. We love buying stupid shit all the time. You want proof? Just look at Five Below. America spent $2.4 billion over the past 12 months buying crap that they probably won't use longer than a week at Five Below. $2.4 billion in sales that company did. Seriously, just look at what water balloon pumps, fidgets, an inflatable outdoor checker mat. I mean, listen, I'm guilty. I go to these stores. My daughters love it. And hey, okay, I'll inflate. Yeah, I'll play check. A week later, it's gone. Fidget, they play with the fidget. It's gone. A week later, they're not playing with it anymore. I mean, I love it. I'm making fun of it. But I've never seen a store sell so much useless stuff in my life. It's pretty easy to do when you have money to spend and money to burn. And again, everybody's been handing checks like crazy. But trying to stop hyperinflation, when you're looking at it, it's usually too late. It's usually too late. And that's what's happening right now. We don't have hyperinflation yet, but we have significant inflation. And the Fed has even hinted that they're going to raise rates. Now, we have a Fed meeting coming up. I'm doing this midday Wednesday. So you're watching this later in the day if you're watching on a Curzio Research YouTube channel or you listen through iTunes or whatever. I think they may address it because we saw some really big names come out and say, hey, you really need to start addressing this. But the Fed not even concerned, and that's really what scared the shit out of me 2 months ago. Saying on the podcast, it wasn't just how the data turned so quickly, where the CPI turned, and you're looking at annualized gains, and you're looking at, I'm like, right now we're at 4%, 5%. Nobody's talking about that. Are you kidding me? And the Fed's blind. They're not doing anything, and it's going to get higher and higher. We all see that. I guess everyone's calm about it because it's inflation, and we haven't seen it in more than 2 decades. But here's the big problem. Here's the thing that's not being mentioned on TV and the media. This is the biggest point. The Fed can't afford to be wrong on this. They can't hope it's going to be transitory. It's not like the credit crisis where, they know nothing and Kramer went crazy. Oh, nothing. So funny. I was working for him during that rant. And coming from New York, if I ever had a rant like that and I'm yelling and my friends are around me, they'd smack me right across the face. They'd get a grip. Wish someone did that on TV. It would have been funny. Anyway, they know nothing. He was right, though, right? Kramer was right. They knew nothing. They were raising rates at the time. And he was talking to hedge fund managers, seeing how everything was blocked up. It was terrible. More pain was coming. I don't think anyone knew just how much pain. But the Fed was really late to the party. Had no clue what was going on under the hood, especially They just financially, AIG, I mean, they didn't know about AIG till like mid-2008. But the Fed came out and they fixed it almost immediately. Here's $500 billion, backstop the banks, bail out Fannie and Freddie, bail out AIG, everything's fine. I mean, how quick was that? After TARP, did we see the markets coming back? Less than a year. Just throw money at it. That's cool. Hyperinflation? Or trying to control inflation, totally different. And if you want a good analogy, it's like having, bad kidney stones. One of the most painful things in the world. How do you get rid of it? Drink a lot of water, which means you're going to be in a lot more pain, and you're going to try to pass it out. I mean, it's tough. It's extremely painful. Sometimes it can last for 30 days. I don't know if you've seen kidney stones, but it's not like, hey, I got kidney stones. Okay, here's a shot. You're good. No. Here's the process. It's a lot of pain. But it's truly amazing how nobody gave a shit about inflation a few months ago. And now everyone does. It's all over the news. And why is it such a big deal? I mean, not just the numbers, but this impacts everyone. This isn't just a stock thing. It's not Wall Street, but every retail investor, every family, everyone. And I'm using that term truly amazing because all of you, and I'm not just talking about listeners, but everybody saw this coming miles away. Miles away. I mean, you're better equipped at seeing inflation than Fed governors, economists. They get paid millions of dollars to do this job. Why are you better equipped? They do zero boots on the ground research. They're not out there like you. They're looking at lagging data. And the lagging data they're looking at, if you look at GDP, no matter what you look at, if it's retail sales, if it's PPI, CPI, it gets revised 3 times. You have GDP come out and it's growing at 6%, and it beats the estimates of 5.8%. You guys won't realize that next month gets revised lower. Maybe to 5.8. Then it's like 5.6. Then it could be like 5.4. It gets revised 3 times. That's all lagging data they're looking at before they catch up. You're out there. You're shopping. You see everything. I mean, you listen to these guys on TV. I mean, their job is to be on TV all the time. They're not in the field either. These guys get driven to wherever, Fox, CNN, and driven back, right? They got their own drivers, live in expensive neighborhoods. Sure, they don't do their own shopping. Sure, most don't eat any fast food restaurants or go to local bars like you. Because people that did that saw exactly what was happening. You saw the huge labor shortage. You saw, you go into almost any restaurant. They have signs on them. I mean, I know you've all seen them. Please be patient with the employees. They're working hard. We're incredibly short-staffed, or we're closing early. We have business operating at 60% capacity, not because of COVID, because there's no workers. They're getting paid more to stay home than work anywhere. You want proof? The numbers came out, 9.3 million jobs available. And it's about 9.2 to 9.3 people on unemployment. So if you want a job, you can get it. Say the employment rate's really at 0. Yes, there's different areas are going to have more jobs and different skill sets and stuff like that, but there's jobs available. Take away the punch bowl, and people are going to have to go to work to pay their bills. But until then, you have companies operating at 60% capacity in the services industry, and they need to be operating pretty much more than 75%. I would say 75% is break even. Everything else is gravy for some companies. A lot of expenses, employees. So now if you operate at 60, 65%, what do you do? How do you stay open? You raise prices. You got to raise prices. And we're all seeing that. You're all seeing that. The Fed's not. The economists aren't. They don't get it. I mean, you're going to the supermarket. You're seeing the cost of food explode. You're filling up your car every week where gasoline prices are surging. You're seeing your neighbors remodeling their home. The value of your home going up 25% in what, 6 months? Friends that you grew up with that you know very well driving $75,000 cars when they're sitting on $100,000 in student debt. Very easy to borrow money. Yes. And also every bill you're paying. Electricity, cable, wireless, streaming, even water, much, much, much higher. And we're not talking about year over year. We're talking month over month. Every month they're higher. You see it. So guys, please keep that in mind. Because you have a significant edge over Wall Street when it comes to investing. And yeah, these guys have the inside track on certain things, certain levels that can invest in very early stages. But when it comes to these trillion-dollar institutions trying to shift money and reallocate, they can't move that type of money without the world knowing. And they can't always move it fast enough to adapt to these major market shifts like we're seeing. 3-4 months ago, no one complained about inflation. 2 months ago, I was talking about, we see tons of people come out. I mean, it's a pretty big shift over the last 3 months where no inflation, so tons of inflation. But they can't move money fast enough without massively moving the markets. I mean, it's the reason why you see crypto is now $1.3 trillion market. Could be $1 trillion or $1.5 trillion, depending on when you're listening to this podcast. But it's such a big industry now. That's why you're seeing institutions get in, because they can move money in certain areas without too many people knowing. It's liquidity. It's what you need to move markets. To scale, you need that liquidity. So right now, guys, you should be positioned for inflation. And I talked about this on previous podcasts. You should invest in gold right now. The real interest rates are at their lowest levels since the 70s. What is real inflation? It accounts, or the real interest rate accounts for inflation. Meaning that right now interest rates are close to zero. But as inflation goes higher and higher, if you keep your money in the bank, it means you're going to earn less. And now it's negative, and it's going even more negative and more negative. It's declining even further. But yeah, the real interest rate at the lowest level since the 70s. It's great for gold as a store of value. I also like Bitcoin. I wouldn't say Bitcoin's a store of value. I mean, ask the guy who bought it at 60,000 if it's a store of value, because it's 40,000 like a month and a half later. But still, it's a play on reckless government spending. And I like Bitcoin here. And any young investor is probably going to buy Bitcoin compared to buying gold, because gold is just too boring for them. Bitcoin's a good alternative. Also, still at this stage, invest in the reopen trade. We've done incredible through our portfolios. Recommend hotels, casino stocks that got sold off, travel-related stocks. And giving one away, Avis was a great winner for us. We're up over 300% buying that not long ago. Infrastructure names. Right now, you've seen a lot of these names go up, and you're like, wow, I missed the move. They're up 200%. A lot of times, these things continue to go higher. Get tons of money. They're inflating the markets. I mean, these are good trades right now. And I see a ton of opportunity if you want to, within a particular sector, I'd say airlines. If you look at the cruises and you take their enterprise value, which accounts for debt, their enterprise, they're trading at a higher enterprise value today than they were pre-COVID. There's no cruises right now. How's that possible? So they're a little ahead of themselves. Maybe they go higher. I don't know. Airlines roared back. They're still well off their highs, but the last 4-5 months, they kind of haven't moved. And they have exposure internationally. Well, China's opening up. Asia's opening up. Europe's starting to open up, especially Euro Cup, guys. Great games. Germany, France, biting, goals taken away, fight. It's just, yeah, love soccer. People just throwing themselves like they just got shot. They get up there okay. But they only have half the crowds there, and I'm telling you, people are going to die because soccer's amazing. I won't even go there. I went to World Cup 2016. Greatest sports experience. I've been in so many different venues, of course, all sports. Never seen anything like that before in Brazil. Unbelievable. Those guys are dying to get back. Again, everything's going to be opening up. Just buy an airline. They still haven't. They're trading around 20-25% off of their pre-COVID highs. So they bounced back a lot, but still, I mean, try booking a flight. They have incredible pricing power. Everybody has money. Everyone's looking to get away. Even trying a rent-a-car. I have a friend who's going to come in for a month. Actually, one partner is going to come in for a month with his family and hang out where I live in Amelia Island, Florida. And he wanted to rent a car. And he's like, Frank, do you have an extra car or anything? He said, I was going to rent it. It's $4,000 to rent the car for the month. $4,000. $4,000. Anyway, I mean, you're looking at the airlines, and that's rent-a-cars, good favors, I guess. But you're looking at airlines. These guys have plenty more room to run. I'd say they went about 60% of the way, and they should be touching all-time highs because those margins are going to explode. They're going to be buying new planes like crazy from Boeing. They had all these orders in due to high demand. They had to cut back. I mean, that demand's coming back. It's going to be much, 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 much greater than it ever was. So they're going to continue with those orders. You'll see Boeing come back, but the airline industry is a place where you could definitely outperform. Now, is there a chance that we do not see hyperinflation? Absolutely. I mean, the bond market for now is not pricing in huge inflation, but To be fair, the bond market was not pricing in anything to show the credit crisis late 2006, 2007. At least not from the data I look at. But I do have a friend who's the largest, or one of the largest, I'll say, or if not the largest independent bond fund manager. Probably saw that coming back then because he's one of those people incredibly smart, just sees things nobody else does. It's also been mentored to me. He's bouncing ideas off him. Great guy. Very, 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 very smart. But I mean, he saw it coming. But still, I remember looking at 2006, 2007, it didn't really show. So I don't know what, the bond market's not showing. And that's the argument. And of course, inflation could be transitory. Maybe they're right. But the Fed cannot afford to get this one wrong. They can't be late to the party. And in fact, they're not even concerned with inflation. That's what scares the hell out of me. Again, they may come out right now. It's before the Fed meeting. They're meeting. They're going to come out and I'm sure with all the big names that are worried about inflation. Again, JP Morgan has a direct line into the Fed, and a lot of these guys do. But maybe they come out and say, okay, we're not seeing it. Maybe interest rate, again, I think November 22 is expected interest rate hike. You see that push forward a little bit. At least talk about it. But for the Fed not even to be concerned when we're seeing these numbers is insane. It's insane. I mean, the Fed should be raising rates right now. And that's why you should position yourself accordingly. Because the Fed right now, pedal to the metal. Continues to buy bonds, low interest rates, not worried. Even though stocks, home prices, commodities, everything near all-time highs. Wages are rising, all the bills you're paying. Every company in the world is raising prices. Just listen to conference calls. Everyone is raising prices. They need to. Even though the Fed has added close to 35% more money to the system in the last 14 months. And more is coming in infrastructure, which, by the way, I don't care what party you're on, but about 10% of that bill was for infrastructure. Everything else is for bullshit. Again, more money being injected into the system. They're not done. They get addicted to this, the politicians. They love it. They love when there's a crisis. They love it. Increase spending, get money for everything. They all become incredibly wealthy. They love when it's a crisis. Push the issue, get as much money as they can, because it benefits them. But take advantage of this trend. You have the opportunity. Yes, you could be wrong. If you're wrong, it's not going to be a big deal because we're still going to see inflation. But just looking at all the data, not to mention Ford, GM still have plants idle. It's not because there's not enough demand. It's too much demand, not enough chips to put in these cars. And when has that happened ever? When have you? I've never seen that. Maybe you've seen it. Maybe you work in different. I've never seen closing plants because demand is too strong and we just don't have the parts. I don't think I've seen that before. The idling plants. Usually, okay, we'll increase capacity. Have these people work. No, they go home. We don't have the parts to put in the cars. Go home. That's crazy. It's absolutely crazy. Make sure you position yourself accordingly. We were talking about this months ago. Everybody's talking about it today. That's my job, to get ahead of things. So we did COVID and other things. Again, this is because of you. Because of the network I have out there that we get stuff in real time and people, dealerships, emailing me. This goes out to 100 countries. I mean, so many people emailing me data on COVID that I haven't seen any place. I remember coming to the podcast and telling people, and they were like yelling at me, Frank, you don't understand. I'm like, actually, no, I kind of understand it. You're just listening to the wrong freaking people. And you're starting to see all this shit come out now. But it's because of you having this massive network, which is amazing. And frankkurzioresearch.com, you guys email me all the time. You have real-time data, access to real-time data through your businesses, through everything. But a lot of these people on TV, they're looking at lagging data, looking at things in the past. I mean, it's created a significant advantage for me. I'm not some kind of genius that just sees the no. I listen to a lot of people who have a great network. And just the amount of people across different industries that own their own businesses, that even go to colleges, that email me the biggest trends coming up or what they're seeing inside their school, what people are buying, what they're using. I mean, it's unbelievable, the access to information, and that's what I always wanted to create here. So I love this. Been doing it 14 years. People say, why do you do a free podcast? It's not free to me. The information I'm getting, the fact I can interview great people all the time, man, holy cow. That's resulted in the portfolios outperforming for a very long time. It resulted in just getting ahead of trends well ahead than you see mentioned in the media. And again, talking to these brilliant people every single week where they have a different opinion than me than not. I mean, doing that for 14 years is pretty freaking amazing. That brings us to today's guest, who's awesome. Brilliant, brilliant, brilliant analyst. He's not been on close to a year. Going to have him on a lot more often going forward. And having him on a year ago, I think, is one of the most widely listened to podcasts for Wall Street Unplugged. His name is Harris Kupperman, or Kuppy for short. If you follow him on Twitter, you probably have a lot of fun. He is the founder of Praetorian Capital, hedge fund that invests pretty much in contrarian industries, asset classes, places that people hate. It's more like a value guy, gets into certain sectors and things well ahead of everybody else. Also founder of Venture and Capitalism, that blog where he does an incredible job sharing trading ideas. He also has very strong opinions. That's why I say if you follow him on Twitter, you probably love it. He speaks his mind, which I love. I love people who speak their mind. I guess it's a New York thing. But I love it. You know exactly where they stand. This is going to be entertaining, definitely educational, and you're going to get some cool ideas. So make sure you listen up, and let's get to my podcast with Kuppy right now. Harris Kupperman, Kuppy, what's going on, man? It's great to have you back on the podcast.
Hey, thanks for having me back.
Well, I follow you all the time. I think it's been like a year since you came on, and I'd like to get you on even more, at least quarterly, because I love reading your tweets. I love your research. And I want to start out because of the new revolution that we're seeing, which is called ESG, which stands for environmental, social, and governance. And you know where I'm going with this because you have a different meaning for it, don't you?
Yeah. I see it a little differently. I think it means energy stops growing. The world runs on energy. I mean, that's since the Industrial Revolution. Well, I mean, since humans learned how to play with fire and they needed wood, I mean, society runs on energy. And so if you put a bunch of regulations in place and stop the growth of energy or, maybe even make energy, usage shrink, well, it seems what the plan is. And that should be pretty good for energy prices, I think, because I don't think the demand's going to slow at all.
No, I think you're right. But have you seen anything like this before where, I mean, it's small groups of people, right? When you're looking at Engine 1 for Exxon, you look at Chevron, especially, the oil companies where, I think it's like a $50 million stake that these guys have, which is nothing in Exxon. However, they're able to convince people like BlackRock and other firms of trillions in assets in the manager to support them. I mean, is this a fundamental shift where, look, you could agree with it, not agree with it, you could be pissed off and say it's BS, but it is going to have a significant impact on what these companies are going to do in the future.
Oh, yeah, absolutely. It's really dramatic. I mean, I think, let's unpack this into a few pieces. I mean, the first piece is that everyone looked at ETFs as being this sort of benign thing. They buy all 50 stocks, and it's a low-cost way for retired people to get a little bit of exposure to the market. Suddenly, 4 or 5 individuals control these, BlackRock and Vanguard. Suddenly, they wield unusually dramatic power at large corporations. Where, normally, 500, what's Exxon, $500 million company? Normally, you wouldn't have people who could amass big enough stakes to influence the outcome. But here you have 3 or 4 people that control what's going to happen at the company. It's sort of terrifying, really, because no one voted for these people. No one asked if they, were the best for society. I mean, look, I'm a shareholder of some of these things, but I get no say. It's kind of just weird. So it's a terrifying development that I'd never thought ETFs would get to. I always thought ETFs would just be, focused on earning a few basis points for the owners, not, changing society. So that's the first thing. And I don't know where this is going. I mean, first it's coal, then they're after energy. I mean, what if they don't like, some other business? They could do almost anything. They could mandate anything. It's really quite scary. And I don't know. What thoughts do you have on that? I mean, obviously, I'm not the only one.
I mean, look, I'm a stock junkie. I've been doing this 25 years, and I just find it fascinating as someone that combs through, loves earnings season, combs through, try to find ideas. Every single company, right? Every single company has a portion of their quarterly presentation, if you're looking online or whatever, dedicated to ESG. Like, they have to say it. If not, they're going to be attacked. So regardless of what they think in the situation, and that's what really pisses me off is regardless of how they believe in something, whether they believe it or not, they have to do it because they're so afraid of getting attacked. And that makes me think that their interests are not in the best interests of the shareholders, because that's not really – I want an energy company to drill more and generate more money, right? But if you're going to – if you can't do that, then it's change your thesis on the stock, right?
So this is a funny activist campaign because normally activists could look at Exxon and say, hey, look, they've been paying too much dividend. They really need to repair the balance sheet. They really need to invest for growth. They, maybe they want to buy back instead of a dividend. There's a lot of things you could do as an activist shareholder that maybe you're right, maybe you're wrong in the direction you want to take the company, but you buy enough shares and you have a say and you influence the outcome. This is a situation where I'm not sure if the activist cares if the shares go up or not. They're doing this to grandstand because they're launching their own ETF. It was good marketing. I don't think they actually care what happens to the company. It's the first case of activism I've ever seen from a shareholder. Then, they own a few basis points of the total equity. It's a rounding error. I've never seen that either. Normally, if you want to be an activist, you go out there and you buy a few percent of the company. I mean, I've never seen an activist like, General Electric, those guys bought 2-3% of the company and they influence the outcome. But normally you have to buy, 10%, 20% of the company for people to take you serious that, you're actually going to get board members out there. The whole thing's bizarre. Someone else is probably behind this and we'll never learn who, or maybe we will. But, it's dramatically changed corporate America. And if they're doing that here, the rest of the world's only a few quarters behind.
Very, very true. And I know this is impacting the oil industry because it could result in few, much less development in the industry, which looks like the way it's going, which is going to probably push prices a lot higher. We're so dependent on oil and natural gas, was 75-80%, I think, just in the U.S. I mean, we would love to, not we, but you and I, but a lot of people would love to go to wind and solar and don't realize that it's not base load power. But it is going to be interesting what happens to this industry in particular. And let's talk about this industry when it comes to energy. You were very, very early to this. And I'm a big fan of energy. I've researched the death for so many years and decades, actually. But when you came out, and this was very early stages of COVID, and I did a great job researching COVID tremendously in January, knowing he was definitely going to come here just with the context I had in China and Italy and those lockdowns and stuff. I actually thought you were a little crazy to go that early. I'm like, all right, I know a company likes like deep value and stuff, but you almost nailed it completely, right? And now you're seeing the massive gains, but based on what we're talking about here, it seems like oil prices could easily go a lot higher from here. Is it hard for you to buy stocks when they're up 300-400%? Because one, you benefited tremendously, but would you be adding to your positions here, which doesn't make sense on big winners? You want to take some off the table. I mean, what's the strategy here? Because it looks like that energy has another leg up here.
So I think there's another leg up. I mean, normally at this stage of the cycle, energy companies would be increasing their drilling budgets. And, with about a 2-year lag, you'll see a lot of supply come. And that's why it's a cyclical industry. It tends to oscillate from big boom to big bust. And, it's a tough industry to invest in, but it's very cyclical. But this time, I don't know if the drilling and capital expenditure cycle will kick off. I feel pretty confident in saying that, through crises and whatever else, energy demand grows between 1 million and 2 million barrels globally every year. It just, look at a chart of it, just keeps going up. I mean, last year was a little odd because of COVID, but I think we're going to be caught up to that 100 million we were before COVID started. And then it'll just keep growing 1 or 2. And with all the stimulus, maybe it grows 3. And I don't think the supply side's coming. And I think you're going to have a huge boom in energy prices. How do you play it? I mean, I don't think anything I'm saying is all that contrarian anymore. I think it's actually consensus, a little scary, but I don't see what, changes it. I don't think people have really thought through the ramifications, though, because we've been living in a world since 2014 where, oil has kind of been between 40 and 60. So no one really thinks about the price of oil in their day to day. But what if oil goes to 200? I think you might need something crazy to happen. How am I playing it? I own a couple oil stocks that I bought at the depths of the crisis. But honestly, I've been peeling a bit off here and there. I kind of worry that, you have a rogue court in Europe that attacked Shell. You have, executive orders here in the U.S. You have, Colorado passed an ordinance, made it harder to drill. I think, owning the producers is not the way to play it, though you will get some spectacular wins along the way. I own some energy services companies. I think offshore will come back in a major way, and no one's predicting that, because while the U.S. will make it harder for people to operate, I think you have countries that are poor that don't really care about carbon dioxide, and, West Africa, Guyana, Indonesia, all these places that are growing production, and at a higher oil price, they're just going to go produce. and they don't really care. So they can take these drill rigs that are in the Gulf of Mexico, and they're just going to mobilize them. And so a lot of the drilling companies, you could buy a bunch of that steel at 10, 20 cents in the dollar. And usually at the top of the cycle, it trades at, 2 or 3 times uh, replacement cost. So, there's a big move from 10 to 20 to, I guess a 30 times move. I own some of that. I own some other services. But the real way I'm playing this, I'm just buying oil calls. 2025 oil future oddly trades at 54, while the front month trades at 70, because everyone's expecting shale to ramp up and, for oil to basically readjust back to the 50s, where it's kind of been in its band for the last 6 years. And I don't think it's going to work that way. I think 6 months from now, people will start realizing that the supply response will be slow and the demand response will be more aggressive than people expect. And I think that part of the curve going out a few years will get really bid up. I mean, and because of the fact that it's currently backwardated, you can buy those calls very cheaply. So I bought a whole lot of those calls. And the thing I like about call options when vol is cheap is you know exactly how many dollars you're risking. I mean, oil went negative once in my life. Could do it again. Futures are very levered. You want to be careful. But, in the end, you buy those call options, you know how many dollars you're risking. And if it turns out like I think it's going to, they could be multi-baggers. And, I think it's a lot better than buying some producer where you get an executive order and suddenly, you get zeroed. Where, here, if they go out there and zero some producers, my oil calls just do better. Sometimes the simplicity of it all is the beauty.
Yeah, it makes sense. I love the way you're playing that too, through the call options. And wow, I mean, deep offshore drillers. I remember that industry used to be Transocean, Noble. Those companies are great when oil prices were 90, 100 for several years over that stretch. But man, those guys have disappeared, and that's interesting industry to look at. I love that industry. So I appreciate those ideas. I want to change tunes here because we're research guys, data guys. How are you looking at what's going on with the Reddit crowd? AMC, GameStop, Dogecoin events, and I'm to have the same reaction as you, right? I'm laughing, but for me, whenever I miss something, if I miss a trade in something, it's, I'm hard on myself. I'm like, okay, what did I miss? Is there a way to look at this industry? Because there's no denying the gains, the spectacular gains. I mean, so we could sit here and laugh and make fun, but if you're looking at the massive gains, is there a way for investors to capitalize this? Is this just a BS trend? I mean, we know that the valuations don't even come. I mean, MKM Partners came out with their reiterated their $1 target price on AMC, and it was based on fundamentals. I'm like, what are these guys doing? I mean, you should raise it to at least $2, right? $1. Anyway, how do you view? Do you view it as, well, why am I missing this? What is this a fundamental change in the way people are going to invest, bring on more speculation to the market? Or is it like, hey, I'm avoiding this. This is totally BS. I'm just curious how you see this.
Well, obviously, it's just blatant speculation. It's not very different from buying Dogcoin or Titcoin, or I don't know which other coins are popular. They get popular for a few weeks and then they kind of fade away. And some people make a lot of money and some people lose a lot of money. But it's just a big video game in a way. Obviously, these are untethered to any sort of like fundamental value. In terms of how do you play them, I think this is for professionals to play at home and be very careful, and you play small. But things in motion tend to stay in motion for longer than you think. I've been playing these on the long side. I'm terrified to short them. But volatility spikes dramatically, and there's money to be made playing them by selling straddles or selling strangles. There's a lot of ways. You got to look at your option chain and see where vols are. But there's ways to make money by just selling volatility and taking a view that things will eventually mean revert. And I use the word eventually, kind of highlight that will eventually mean revert. And if you can stay with it long enough, you'll probably do okay. And in the history of life, if you sell, straddles on something with a 300 volatility, you're probably going to do okay. I'm not going to say that every one will work out, but if you do it small and diversified across a lot of these meme stocks, you're probably going to make some money. Because remember, these guys, they all have their, Robinhood accounts, and they're slinging 1 and 2 lots, and they don't really understand, volatility. They don't understand that how much they're overpaying. And so they're buying these things. And, if you're taking the other side of it, you're probably going to make some money, but you will get ran over sometimes. So please play small. Please be patient. But I don't know. So far, that's how I've been playing it. And, I'd say I make money on about eight out of 10. And, 1 or 2 out of 10 really hurt bad. But net, I'm doing well.
And let's talk about that. Let's talk about your strategy because, which I love to do with great analysts like yourself. You see, it's based on 2 core principles. So identify a relatively small number of really exceptional companies that could increase more than 5-fold in the next 5 years. You say 5 and 5s. And also focus on company sectors undergoing some sort of inflection. Just based on that, to me, it shows me how many different styles of investing. I mean, it's top down, bottom up, right there. It's just, I'm sure you're not really focused on technicals, but sometimes you do if you're looking for inflection points. What does this lead to? Because if this is your strategy, for me, it looks like that you're really, really focusing on small caps.
I do a lot of small cap. I don't talk about it much just because I don't like talking about small companies. But I do a lot of small caps, a lot of, our sweet spot's kind of in that 100 to billion range. And, we're looking at stuff that's having some sort of inflection. Maybe it's a management change. Maybe it's an industry change. I look at a lot of cyclical sort of businesses, a lot of things that are having some sort of secular change. But there's a lot of cheap companies in this world. And there's a lot of really smart guys that have a Bloomberg and know how to scan for them. So just because it's cheap doesn't mean anything. You need to find something that's cheap that's things are getting better. Wall Street pays up dramatically when things are getting better. And when things are staying the same, but they're cheap, Wall Street just doesn't really care, Oh, great. It's 7 times earnings. I get a dividend. Who cares? It's when, you look at it and you have that FOMO of saying, wow, earnings are really going to grow next year. That's what gets Wall Street excited. And to have growth, you need either revenue growth or something happening on the cost side. But Wall Street really likes the revenue side. So you need something that's changing in the business. And that's what I'm trying to figure out. What's driving this and what's changing in the world around me. And I usually start with the top down. What's changing in the world around me? And then how do I play it? Energy prices going up. Got it. I know how to, now I go figure out how to play it. You look at any of the trends I've been in for the last, while. Copper prices up. Well, they're going to go drill and look for more copper. I'm going to buy some hard rock mining, exploration, drilling companies. They're going to do, this. I'm going to go find that. And then you look at the couple of companies in the industry, and I tend to buy, the guy that has the better balance sheet. So if I'm wrong, I don't get hurt too bad. Obviously the guy with the worst balance sheet is the fulcrum security, and you have the most upside. But if I get my thesis right, I have enough upside. The whole point is how do you protect your downside? And that's by, making sure you have a clean balance sheet. And then from there, you just put it on, you kind of forget about it. This isn't rocket science.
And you don't use stops, right? So it's basically, if you really believe in a thesis and something comes down, a thesis is still intact, and maybe it's just taking a little bit longer because things, that pendulum could swing one way or the other way much, much further than anyone believes. Is it, hey, I'm just adding to position and staying patient with it? Because that is a discipline, right? That's not the easiest thing to do if you see something come down 30, 40, 50%, which was the case when I saw some people recommend oil, but they're up tremendously now. But, they were a little, and usually good investors, great investors, I don't know if you agree with this, are usually a little bit early to their trades.
Oh, a lot early. No, I don't believe in stops. I believe in getting the thesis right, and I exit the position if I realize I got the thesis wrong. And, sometimes the stock is up and I go, wow, I got lucky. I got that totally wrong. And sometimes the stock is down and I go, wow, this thesis keeps improving. I'm just going to buy a lot more. And I'm focused on the thesis, not the stock price. Obviously, I look at charts. I'm not really a chart guy, but I understand enough to know that you don't want to buy a chart that keeps making new lows. You want to at least wait until it stops going down. Usually, it makes a little bit of a base or something. That's kind of what tells you, hey, it's safe to go now. But I really don't want to buy stuff that's making new lows, and I don't want to buy something that's up too much because then I'm paying for, it's already starting to get priced in. I want something that's stopped going down and it's just starting to curl. Is the word I use, where it's just starting to, make new highs, out of a base. And that's usually the indicator that I'm probably right about my thesis. And then from there, I just ride it. It's volatile, and there'll be, shakeouts. There'll be these moments that really test your, resolve. But if you're right, you're right.
Yeah, no, I hear you. If you're right, you're right. Yes. We're wrong. Sometimes it could be a little painful, but sticking to that thesis. I understand that it's, most value investors do, right? Most value investors, listen, they believe in that thesis and they'll stick to it. But I love the fact that you said, look, you need to see something going on with the company that's changing it, where if it's revenue, if it's earnings, an event driven, something's going to change where, you see in that kind of growth because, that's where the premium comes from. Great stuff there. Now, the easy
But
question for you, go ahead.
so I was just gonna say, I mean, usually in this macro stuff that I do, or I call it micro actually, because macro is like interest rates and
Mhm.
currencies, and micro is how many dollars we spent in hard rock exploration next year, or how much will be budgeted for offshore. Like those are micro trends. Normally, what happens is by the time it starts showing up in the numbers, you're too late. You really got to see the trend and say, I see this happening. And in 6 months, it's going to show up in the numbers, but I see it starting to awaken. That's when I got to get involved. But by the time it's shown up in the numbers, if it shows up in the numbers, the stock's already doubled because a lot of these things are so depressed because everyone's saying, oh, offshore will never come back again. So as soon as people say, maybe it comes back, maybe not, getting from never to maybe is like a five bagger, So
Yes.
but you also don't want to buy it when it's never because, sometimes it's pitch black before sometimes it's darkest before it goes pitch black, so you want to make sure that you see there's some light on the horizon there.
No, definitely makes sense. And the easiest question for you right now is any sectors to share that are at an inflection point because we've seen so many things get super depressed during COVID and are up tremendously now. I mean, I don't know. I mean, EVs is a story that's out there. ESG, we talked about, it could be agriculture. Even, for me, I'm not a gold bug at all because people have been saying, the currencies and issues and debt and stuff like that since the 70s. It's the same thesis today. But if you really look at what's happening today, where inflation is going through, it's at a 25-year high inflation, and yet the Fed still pedal to the metal, interest rates at zero, which now real interest rates are at the lowest level since the 70s, which has to be very, very, very good for gold, I would think, at least something that has little limited risk and upside potential. But I don't want to sound like a gold bug because I'm not, but I position myself. But what are some of the things that you see? Is there something out there that you see as an inflection point? And I don't want you to give anything away that you're giving, people will pay for your research for, but I was just curious.
Well, I think there's a lot of things that are at inflection points, and we're really early. I think U.S. housing has, there was a decade-long period where house construction was below trend. I think there's a huge catch-up there. I think anyone in the supply chain to housing, I think anyone, anything touching housing is going to do very well. I think it's going to be a multi-year trend, and we're 9 months into it. The stocks have all doubled and tripled, but, on the way to a 10 bagger, you double and triple. I think the reopening trade is a great one. All these companies in the U.S. have gone, absolutely crazy with the reopening trade in terms of price action. And so, I don't know if there's anything to do there, but go overseas. I mean, the same things that worked here in the U.S., a lot of the places, in Europe, they're like 2 months behind America in terms of, they're like 2 quarters behind America in terms of reopening. So, casinos, hotels, restaurants, auto rental, like anything that touches basically living normal life, those companies are all still just, depressed. Go to Latin America. There's been really no reopening trade there yet. I think reopening is going to be a Q3 story there. Like, basically, look at what worked in America and just copy it. It's been one of the best trades we've had actually, by just copying what worked here and buying all the ones that aren't up yet in funny countries. I think hard rock drilling, guys doing exploration. It's been, really 30, 40 years where they haven't had any reserve replacement globally. And those reserves are going to have to get replaced. You don't really have a mine if you don't have your reserves. I think that reserve replacement is going to be a huge trade. And there's going to be tens of billions spent on reserve replacement. And you don't replace reserves when the price of copper is 2. You do it when it's 4.5. So I think that's going to be another great one. I'm just going through what we have here. I mean, obviously this is the normal stuff that everyone's focused on, but those things are already priced like they've succeeded, and the jury's still out. Oil services I think are going to do just great. I mean, I have bits and pieces of the whole oil services supply chain. But those are the trends I'm really focused on right now. Ag. I think ag prices are probably going to be structurally higher for a while. Basically, anything commodity related is going to do great because you have these, like we talked about at the start of the show, you have these government mandated restrictions on production. it's easy to look at what's happening with oil, but the same thing's happening with almost any commodity product. And so there's going to be shortages everywhere, and the global population keeps growing and getting wealthier, so they want more stuff. And there's 6 billion people that want the stuff that the billion of us already have. And so as that trend keeps going, it's a trend that's been going for 100 years. But as that trend keeps going, I think you're going to see demand increase. I think commodities do the sine curve thing. You get like 5 good years every 20, and we're into the 5 good ones now. So I like all that sort of stuff. But I don't know. That's the sort of stuff I'm focused on. Every couple of quarters I get excited about something. But the great thing about this industry, investing, is that you don't have to have a lot of epiphanies. You kind of need like one smart idea every year. And, the hardest thing actually is to look at a lot of things and go, nah, I'd rather just sit in cash. Something better will come along. I think that's the hardest thing, just sitting in cash and saying, nah. And so when the market's gone straight up for a year, I'm much more prone to say, nah. And in March, when, everyone was panic selling, I was saying, I guess, buy stuff. And there'll be a time again, the next, few months, maybe a few quarters, where you can go buy stuff and feel really smart again. But I like to be buying stuff when, they kind of give stuff away. I don't like being chasing. That's just how I play.
Yeah, no, I love it. And what about on the short side, right? I mean, we talk about the opposite of inflection points, but you're looking at, and I think that you've done some work with Citron, and I know Citron's not, they're like, all right, enough of the short stuff. It's so hard to short companies, but you're looking at technology which has been selling off. You look at some of these ESG names that ran up tremendously that are down 30-40% from their highs. And you mentioned SPACs, right? And that you identified on your Twitter page that, you're seeing these major unlocks of these insider shares, which is, going to create huge selling pressure. Is that something too? Or what's your allocation in terms of long to short? Do you go short like big positions when you want to? If you think the market's high, or is it just like, hey, these are certain situations that are going to put, some money on the short side here?
So I don't short much. I mean, I have this thesis called Project Zimbabwe, which kind of says that our Federal Reserve will do to us like they did in Zimbabwe. And the stock market in Zimbabwe basically went straight up, one of thousands of times. And so you don't want to be short if you know the market's going higher or you think the market's going higher. Sometimes I selectively put a little, tiny short here and there. But, most people short because they feel like it's their job as a hedge fund. And I don't see why you have to hedge if there's nothing worth hedging. If you think, I think the most underpriced asset's probably the 1,000 strike SPY call. I think we're going straight up. There's going to be a lot of volatility, but I'm not smart enough to know how to time it. And so if you think the market's going to be higher in 3 months, 6 months, 2 years, like what's the point of shorting it? I see a lot of my friends wasting a lot of their money and a lot of their energy trying to short stuff. And, just like the meme stocks don't really make sense from a valuation, neither do a lot of other companies. So, what's the point of shorting? Obviously, you have these SPACs, they're unlocking. You have this moment in time where a lot of shares are hitting the tape. And, if you look at it from, an odds perspective, if there's a lot of sellers and probably not a lot of buyers, they'll go down. And I've made some money there. But I think it's easier things to do on the long side. That's really where I'm putting my attention. We have this thing I'd like to talk about called CADM. It stands for Kuppy's Event-Driven Monitor, and it tracks.
Before you go any further, I saw this KEDM. Venture Capitalism is your website. This isn't some pump thing, and I'm hyping this up, but you call it institutional idea generation for event-driven special situations, which, that name kind of like, all right, let me take a look at it, right? It makes you not want to take a look at it a little bit. I went into this and it's free, and I went in there, and this must be one of the best things I've seen in terms of research, and you do it weekly. Explain it, because the amount of idea generation and everything, it's just incredible. I haven't seen a product like that. And I'm not even kidding. I've seen millions of products. I really, really, I just spent like 45 minutes just going through the whole thing.
I appreciate it. I'm glad you enjoy it. I mean, look, I never set out to be in the publishing business. I run a hedge fund. That's my job. But I wanted this data, and it didn't exist. And, I do a lot of event-driven stuff, because when you're looking for inflections, the most important inflections are corporate events. You have a CEO get fired, and the new guy comes in. He comes with a new set of eyes, a new vision, a new strategy. Like, there's an inflection in the business. People look at spin-offs and stuff, but that's all been picked over now. But there's a ton of these other sort of corporate events that lead to an inflection in the business. And I felt like I needed a way to keep track of all these. And so I asked a friend of mine if he'd come work with me and start producing this. And, him and I, we thought he'd just build an API and download the data from Bloomberg and we'd be done. And what we realized that a lot of the data that we wanted doesn't actually exist. He had to actually manually create it. And then, the data's buggy. And, we were surprised how much time it took and kind of realized that we needed more eyeballs actually, because I need a few people to do this. And so if you need a few people to do this, it starts getting, kind of expensive for a research budget. We're a small fund. And so I said, let's build this into something that we could sell. And because if I want this data, probably other people do. And if enough people get together, maybe it'll be a little business that's profitable, or maybe I'll just, lose less money collecting this data, but I want the data. And so we launched this thing called Kuppy's Event-Driven Monitor. It started as a free thing that I've been sending to some of my friends. And, eventually we opened it up to everyone because I figured other people would want it. And, it's free right now. Go to kedm.com and sign up. It shows up in your mailbox every Saturday. We intend to put it down a paywall pretty soon and charge for it, just because, like I said, I'm looking to hire a couple guys and someone's got to pay for them. I can't do this pro bono forever. But you were talking about the unlocks, and we track those unlocks. We're going to get a lot better at tracking the unlocks. Actually, that's our first project when we hire new people, and I think there's a lot of alpha there over short periods of time in terms of with an unlock. Let me explain what that is. That's when founders or insiders have shares that after an IPO or a SPAC, those shares are restricted; they can't be sold. And then the unlock is when those shares can now be sold. And a lot of people, they've owned the stock for many years, or they're a PE fund or a venture capital fund, and their job is basically to buy and sell shares. And when they can get out, they get out. And so you have this period of time where there's extra pressure on the stock, and it tends to be a lot of money being made by shorting the stock a few weeks before and covering when all the selling happens. It's not rocket science; it's supply demand. And so we track that plus a couple dozen other strategies, and we're looking to add another 25 or so in the next year to just track all these sort of corporate events and make money. So I hope you all sign up. kedm.com.
There's no way that you're going to be able to continue to do. It's a 100-page report every week. And again, it highlights new ideas, including short squeeze candidates, which is part of the Reddit. You talk about, an ARC indicator, the Kathy Wood monitor, CEO changes, left for dead names, spinoffs, fallen angels, just all the events that happen on a weekly basis over 100 pages. I'm like, man, this guy's, you definitely have to charge for that. It really, really is amazing. I think open it for free, but I have no idea. I know it's charts and figures, and you could have a couple guys do it, but the amount of information that you have there for a 100-page report that really, it's almost like a jump start where you can really get ahead of what's happening for the week and certain ideas and what's going to move the markets. But just the way you lay it out there, it's again, I'm not getting paid for this, guys. I was really impressed. You're like, hey, just mention this KDEDM, and I started, I'm like, holy cow, this guy, he's not charging for this thing.
I appreciate it. Let me flag something. Like we had this situation that was flagged. It's Anglo American spun off their thermal coal assets because ESG, mm-hmm. And so Anglo American's a big mining company, global mining company that did a spin-off of their thermal coal assets in South Africa. Who is the investor who has a mandate to buy thermal coal in South Africa? Nobody. And so, for every 10 shares you owned of Anglo American, you got one share of this company called Thungela. And, a lot of the shares are owned by ETFs, so they just immediately sell it. And, a bunch of the shares of Anglo Americans owned by, funds that have ESG mandates, they sold it. Pretty much everyone, the day they got it, sold it. And so yesterday the stock opened for trading, and it was trading about 110p in the UK. And they had 95p of cash, no debt. And so, this thing is trading at, 15, 20% premium to the cash balance. And it was trading at less than 1 times cash flow. But on EV basis, it's trading at like a tenth of 1 times cash flow. And so I bought a lot. And I bought them at about 115. It closed today at 150. So day 2, it's already up about 40%. I don't know where it goes tomorrow, but it's really cheap. And here's a company that's north of a 200 million market cap company. It's reasonably liquid, trades, $10 million US a day. And we flagged it in Kedem. We wrote about it 3 weeks in a row, said this is going to be a situation where there's all these structural forces that'll make this thing really, really cheap in the first couple of days. And it pretty much happened exactly as we expected it. And our hope is, it's not every week you're going to have a great trading idea, but I think that every month or two, once a quarter, we'll flag something that ought to be able to pay for a full subscription. And so that's kind of what we're trying to do. Without Kedem, I would never have known about this because I'm not tracking South Africa and coal companies. It's the one that would have slipped through the cracks. It may be a lot of money, and I hope there's going to be many more found.
Yeah, I mean, the bottom line, too, is through your contacts or my contacts of being in this industry for a long time. I mean, the goal is to see as many ideas as possible. And just seeing this report, and it just provides those, idea generation, which we're all seeking, and especially in the market now, because every stock you look at, it's up to 300% off its lows, it feels like, especially in some of these sectors, energies, financials. Yeah, just fantastic job with that. You go to your website, Adventures in Capitalism, and what is your Twitter handle? So you can give that out as well, because I know people are going to want to follow. You are definitely entertaining. So
thanks, appreciate it. I mean, my Twitter handle is at @Kuppy. Look, I try to be entertaining. Twitter is just meant to have fun, but I use Twitter also. On the idea side, you throw something out there, and I've got over 20,000 followers. It's probably someone who knows something about the company that'll write something. And I go, hadn't thought of that. It's just a great way to. Just test an idea and see what other people are thinking. But most of the time I'm just, making fun of dumb stuff because most of finance is pretty dumb, honestly. It's amazing that you have people wearing suits doing this because it's really just pretty stupid. But the whole beauty of the stupidity is that you just sit there and, keep your wits about you. And every couple of months, someone will do something just so amazingly stupid that you say, I'm going to take the other side of that. And then you make a lot of money. And most of the time you try not to think too hard because, I think the mistake most people make is they try to, say, oh, I got to be fully invested, or I always have to have, a new idea this week. Or, nah, it's not the way it works. You basically just have a lot of fun and laugh at the stupidity around you. And every once in a while, it's just completely obvious. You make a lot of money.
No. I hear you, man. So listen, Kuppy, thank you so much for coming on. Last time you were on, we got tons and tons of views. So you got a lot of fans out there. You're one of the guys out there, and I'm critical too. That I follow religiously. That I love your research. I love your style of investing. It's fantastic, and keep doing what you're doing, man. There's a lot of people, a lot of big fans you have, and thank you so much for coming on, man.
Hey, appreciate it. Thanks for having me back on. Let's do this again next year.
You got it. So great stuff from Kuppy. Brilliant, love his personality, no filter opinions, which I find refreshing in a world where everyone, or I should say every company, working for major companies, has to be careful what they say these days. Following agendas or whatever, no agenda there. Love having Kuppy on. Probably going to have him on as a regular going forward, which is every 3 months, 4 months or so. But that depends on you. Let me know what you thought. I always say this podcast is not about me. It's about you. So let me know what you thought. FrankCurzioResearch.com, Frank@CurzioResearch.com. And let's move on here and bring in my buddy, Daniel Creech, Senior Analyst at Curzio Research. And we usually break down the latest topics going on this week. Dan, what's going on, man? How's everything?
Hey, things are good, man. Happy Fed Wednesday, Frank. I know you touched a little bit on it, but we got to talk about Jerome Powell. And evidently this is one of the biggest meetings of his career. Which I find a little hard to believe, but
yeah. By the time you listen to this, guys, you're going to know what's going on. Right now, we're just assuming that they are probably going to talk about tightening, or a little bit, considering all the big names that came out, right? And I think that was really important. But
yeah, we'll see. That's the big rumor. It's either now or what is it? August when they go to Jackson Hole, the rich retreat over there. Which is really nice.
Yeah, that's usually really, really nice. It's going to be nicer than here because we actually had an AC issue, which, by the way, Daniel isn't too good in warm climates, even though he spent some time in Arizona.
It's miserable.
But do you want to tell the story? Should I tell it? Because, holy cow.
Well, it's still not fixed. The AC is working right now, which is nice. But I come in the other morning, and it was like 74, 75 degrees in here, which wasn't bad, but nothing's working. Well, it doesn't take very long to where, yesterday was 94, 95 here. Mm-hmm. So it was 81, 82 in the office. Frank, the wonderful leader that he is, stayed here to do something and work, and I left. I went to the cigar bar where they had Wi-Fi and a working AC unit, and worked on a couple things from there. So
let's get to the real story here. So this is my version. So typical Florida. I don't care if this offends anyone anymore because everyone living here knows exactly what I'm talking about. I should realize it. I know it's like this here, but it still pisses me off. But we had the AC problem, and it just went off. And probably one of the hottest days, right? So it's getting into the 80s, and it's really, really hot in here, right? So I brought in fans. Call them at probably 11:30. They get here pretty quick. They fix it. Everything's cool. I'm like, thanks a lot. Thanks so much for coming quick. Good. 2 hours later, it breaks again. So then I call them. This is around 2:30. And, I work late anyway, but just most people say if you're leaving at 5, I call them at 2:30. I say, hey, it's broken. Can you get the guy over here? This is a business. We have employees. It's extremely, extremely hot. They're like, I'm sorry, no problem. We'll get somebody over there. We'll call you. Have someone call you. Yeah, right. 3 o'clock, 4 o'clock, 5 o'clock, 6 o'clock. Nobody's here. I'm working here to around 7-ish. Nobody's here. Call them, and it's like they close at 5. They have a call center. I'm like, is this normal? Do you not, I stayed here an extra 2 hours. At least most people would have. I was staying anyway. But still, you haven't fixed it. You told me you're coming. You didn't call nothing. You didn't even call me. Nothing. I guess that's par for the course in Florida. But it gets even better because now we have no AC. And then I wind up calling. Somebody gets back to me around 8:30 at night and says, look, hey, I work the night shift. I'm just hearing about this. I'll try to get there. I have 3 other jobs before you. I said, that's cool, man. I understand. 9:30, 10:30, doesn't call. My office is 5 minutes away from my house. I would have met him here. Doesn't call. So I'm coming in the office today thinking things are going to be bad, and the AC just is suddenly working again out of nowhere. Thank God, right?
And another guy came by and just asked, this is just recently before I started taping, yeah. And he was looking at things. Well, hell, like I said, now it's working. So obviously there's a power issue somewhere between us, our vents, and the unit. But yeah, I'm sure it'll get hot in here again, and we'll be calling those guys. That'll be funny. We may have to have them on the podcast.
It's so typical. It's just so typical of the service. And yeah, I'll be there. They don't call. They don't ever call. If anyone says they're going to call you back in Florida, just assume that they'll never ever call you for the rest of your life. It never ever happens. They never ever call you back. They never give you a courteous call saying, oh, nothing.
The entire state of Florida, worthless.
Yeah. I mean, it even filters over a little bit to Georgia. I'll probably get some emails in this because my daughter next week has another gymnastics competition. So my wife's been telling me, and I always tell her whenever she tells me something because she plans everything, and she's like, Frank, we got this. And whenever she goes a week out, I'm like, babes, don't tell me anything because it's a waste of time. I got too much on my plate and I'm going to forget it. I said, let me know like a few days in advance. But she's been telling me for like 3 weeks, plan. I'm like, okay, cool. So I'm like, okay, next weekend we're going. She's like, no, it's not on the weekend. I said, what are you talking about? She's like, it's Thursday. It's Thursday,
Ooh,
8 a.m.
8?
8 a.m. on a Thursday.
Nice.
That's when they have her competition. I'm like, I guess nobody works, right? Nobody works. The parents don't work. Nobody works. Everyone's going. It's fine. This is a competition. I know trying to save money, having that event in Savannah and rent it out, whatever you have to rent out, it's going to be cheaper on Thursdays a weekend. But really? Like, I know it's summertime. Cool, the kids are out. But, parents work, right? Don't they work? Last time I heard that most people work, right? I think. Unemployment rate is pretty good. So, I mean, it's low, right? So I wasn't sure if people actually work or not, but I must have missed that memo. So now, Thursday I have to leave. So Wednesday in the middle of the day, I'm going to head out there and get in a hotel, and then it's about 2-3 hours away, whatever it is. But yeah, it's normal, par for the course.
Well, you're having a good week, Frank. That's good.
It is. It's pretty cool. I got to get used to this stuff. Maybe I should just take off, guys.
How long have you lived here?
I don't think they're going to mind. 11 years now, and I cannot get used to it. I just can't get used to it. I can't. I know the way it is. I know the way it's going to be, and it's never going to change, and I still can't freaking get used to it. Anyway, little rant there. But let's talk about the inflation, because a lot of people have been coming out, right? I mentioned I don't want to beat this to death, but Kyle Bass's interview was pretty interesting. How people who have money in the bank are losing, he said, 5 to 12% of their purchasing power. This is based on his metrics, and I said this earlier, non-chain weighted index, which is kind of the way you should actually track inflation. He says it's running around 12%. That is insane. I mean, I see like 6%, 5-6%. Saw like a couple months ago how it just dramatically changed. But again, he's usually a bearish guy. He usually has great stats. But man, I mean, that's not really factored in. And nobody's talking about that, right?
Yeah, the crazy thing about inflation is that you don't really feel it until it gets crazy and or out of hand. That's a great argument, and we've talked a lot, Frank and you, in the past about if you change the measurements, you're going to get different results. So you have a lot of these inflationary numbers that are kind of gamed, for lack of a better word, to not show anything. For instance, when the government reports inflation for us, they don't include food and energy. Well, if you don't have to pay for food or energy, obviously you're going to have some skewed numbers. But really, do you think the average person thinks about their bank account losing money even at 0% interest rates? I don't. Now, I could be totally wrong on that.
No.
But it's not like, because if they did, you wouldn't keep money in savings at 0%. You would shift money elsewhere. And a lot of that has happened on a macro level. But inflation's a scary thing because, like I said, you don't feel it every day. It's just a crazy phenomenon until it gets out of hand. Now, the big thing for me is whatever the Fed says today. I mean, you gotta brace yourself for beyond childishness, Frank, because they are literally, you got all these wonderful, supposedly smart people on TV in suits talking about when is the Fed going to think about talking about tapering. That's the dumbest thing. I mean, how anybody can take our industry serious or from a global scale is beyond me, but we do it. Here we are.
But really quick on that point, probably not intentionally, but the whole world is talking about it, which means that people are worried about it, which usually means it's factored in. And if they do come out today, again, we don't know what they're going to say. This is before the time you listen to this, you're going to know exactly what they say. The Fed, the meeting today, they may come out and say, hey, we're really looking at raising rates maybe end of the year or first quarter. They may come out and say that. And you know what? The market's probably not going to take that big of a hit off of it because everyone's really, really talking about it. It's the top story right now.
You think they're going to maybe say they're going to raise rates this year, at the end of this year?
They're not going to say that, but I think they will.
Okay.
They're not going to say that yet, but they're going to build this thing up, and we're going to see all these indicators get worse.
I'll bet you a beer on that. I don't think they have the goal to do that.
I bet you we do. I'm hoping that we do. I mean, we have to see something because everything's back to normal pretty much. I know there's some people that are still struggling, but overall, if we look at all the industries, the profits that are being made, the revenues, everything's back to pre-COVID levels, and yet they're still injecting money into the system, still buying bonds and keeping interest rates zero right now. It's just... You injected another 35% of money purchasing power into the hands of people, and more is coming. What do you think is going to happen? We're seeing inflation everywhere, not just here, Asia, China, everywhere. Daniel was seeing it everywhere. So, I think it's great. And you know what? Again, maybe we don't see it. It's just the Fed can't afford to be wrong on this. But if you're looking at some of the trackers here, they're saying, well, look at some of the data. Retail sales are down a little bit. They're down because goods aren't being delivered. Then they're talking about housing. And housing is really interesting here. Because
and lumber's pulled back nicely.
Yeah, but it's pulled back, but it's still up incredible. I mean, it pulled back 25%. It's still up 400% over the past few months. So, over the past, 6, 7, 8 months. I got to bring up a chart to see exactly where it is. But it's still incredibly high. So now you're looking at the supply chain issues. And you have to look under the hood, especially in housing, because housing data came out, and there was low expected readings in housing, homes sold, housing starts, and people saying, hey, it's slowing up. But when you look under the hood, those supply chain issues are huge. They're leading to delays where the average time to build a house, and this is from sources where you'll get people within the industry, have gone from 16 weeks to 22 weeks because of supply chain issues still, because of labor pressure still. We're still here. Furniture, they were interviewing some guys of furniture. They said they're seeing backlogs in the supply chain. The cost of a container from Asia, they said, has gone from $3,500 per container, that's pre-pandemic, to as much as $15,000. So Evercore came out. Evercore is I love these guys when it comes to, just economic research, one of the guys I really respect. And they talk about, the key indicator is not a number of homes being sold today, but the number of homes being built today. And they had a great line in one of their reports saying, as long as the pace of construction remains robust, the builder's inventory will age successfully, and the pace of sales will soon rebound up to production capacity with improved margins. Translation: a lot of this stuff is being delayed, and you're seeing a lot of weakness in the numbers because there's major, major demand issues right now, and it's major supply chain issues, and we are not even close to solving them as much as what everyone says. Maybe a little bit in technology, but not so much in the auto industry. Plants are still closed. In some other areas, it's been really bad, and now, it seems like it's getting worse and worse. It doesn't seem like everyone's telling us it's getting better, but wait till you see how much Ford and GM cut production. You heard it here first. Wait till you see how much they cut. They're going to cut production by 30 to 50% over the next 2 quarters. They don't have no cars in the lots. That's what their numbers are going to come in at. And what are they doing? A fantastic job. It's the Tesla model. Let's talk about our EVs for 2030.
Yeah.
For 2030, we're going to be great in 2030. We just go out to 24, 50, 60. That's cool. We'll see 5 recessions in between that. But that's what people like, and they're buying it. So good for them.
What was there was a Bank of America survey where a majority, 70% of fund managers think that inflation is going to be transitory. What you just mentioned reminded me, I think The majority are not expecting a recession until like 2024 or something hilarious. That's a hell of a runway for markets to just move higher from where we are now in 2021 to 2024 or 2023. It doesn't matter. So, Frank, why is the 10-year down over 10% from the March highs?
Yeah.
When we have all this crazy data coming out? How in the world are yields continuing to come down? And there's two ways to fight inflation. I know you're a big guy on the rate hike, but like Volcker did, or Volcker, however you say that, Volcker.
Volcker.
You either raise rates or you take money out of the economy. Well, naturally, if things keep on the same pace as they are now, what expires September 6th nationwide? The unemployment extra benefits. So by definition there, you're going to have some money being taken out or at least not injected into the economy. Some states are already rushing ahead of that. A lot of that's political, getting people back to work, et cetera, et cetera. But you have a couple of movements right now that over the next course of the years, you're going to have less money being dumped into the economy. That's interesting to me. And again, the massive moves in treasuries, I don't know if you saw the long-term chart between yields and interest rates, but these things move over decades and decades. And it's wild to me how we've had all this info coming out since March when the 10-year hit about 1.7-ish, give or take. That's a huge move, Frank. 10% yields with all this kind of shoving it in our face. Either we're way too complacent and the Fed's going to pull the rug out under your feet and shock everybody, which I doubt it, just because they don't have the spine, or B, you need to focus on companies with pricing power and stronger brands going forward because everybody from Lazy Boy to Procter & Gamble and every conglomerate is raising prices, as you've talked about. Well, something's got to give, Frank. So it's either margins, a multiple in the market, or whatever. The short answer there is brace for volatility and focus on good names during sell-offs. I know that's very general, but I'd like your thoughts on inflation going up as far as pricing and consumer goods going higher, but yet yields are manageable, let's say.
Well, for the first thing, it makes sense with the survey, right, with the hedge fund managers, and it makes sense from bond fund managers where they're not seeing this inflation, and that's something that you have to take into account for. People say in the bond market, they don't say the bond market is much bigger than the stock market. However, if you look at past periods, I mean, the bond market was not really a good indicator for the credit crisis. If you're looking at 2006 and into 2007, right, it didn't give us these huge, massive warnings, right? So usually you see people most optimistic at the, when it's near the top. I'm not saying that, it's cause for crash, but even when you're looking at the 80s, Daniel, when you're looking at interest rates, which, peaked in 81, whatever, around, look at actually the 10 years, like 15.7, which is rising. But, in the 80s, it came down to, by 82, it came down to 11%. And then it went all the way back up again, even though, we were trying to control inflation. But is the 10-year the best measure of this? Is it the end all? I don't know. I mean, people are looking at it saying, okay, the 10-year should be a lot higher. Interest rates are going higher. This is what we're going to see. Again, it's not being priced in right now, but that's kind of the scary thing for me. It's not necessarily like, if the bond's not worried about it, don't worry about it. And again, we saw certain things, credit default swaps really go through the roof. And there's just ways of seeing it, but that pretty much happened in late 2007, 2008. But when it comes to the 10-year, it's not being priced in and people don't believe it. That's what scares me because you can't afford to be wrong on this. Again, you can't be late on this. You can't say, and the fact that we are seeing inflation at a 25-year high on the main gauge that the Fed looks at that's pretty much designed not to show inflation. And I have a Fed coming out saying, hey, we're not worried. It's going to only be short-term. You can't afford it because if you think it's only going to be short-term, you're not going to do anything. And we're seeing prices get higher and higher, labor shortage, it's going to get a lot worse. And then when they decide, wait, it's going to be too late. That's why you need to position yourself. The good news here, Daniel, is that when you position yourself here, what are you going to do? Buy gold, Bitcoin, I covered it earlier. But the good news is when you position yourself in these things, if you're wrong on inflation, we're still going to have inflation. Maybe it's not hyperinflation. You're still going to have a chance to get out of these things. But for me, it's almost, I won't say it's never a no-risk trade. But from a risk-adjusted basis, positioning yourself for inflation right now makes a lot of sense because these stocks should still do well as everything reopens. China's not fully reopened now. They're getting there. And so is, Europe's going to start opening. So you're going to see, a lot more inflation coming. These asset classes should do well. And if we don't, we'll probably see a move back to technology and technology stocks doing better, which we're kind of seeing a little bit as the 10-year is going lower. But, to answer that question, look, it's not showing. I understand that. But for me, it's not I'm not out of the market. I'm not saying everyone get the hell out of the market. I'm just saying, look, position yourself, because I can't believe that the Fed's not addressing this and really doesn't care about this at a problem that it's very, very difficult to control. It's going to be very painful, and nobody really remembers that, because last time this happened was the 80s.
Yeah, that's a good point. And the wild card here is that whatever Powell says today, you almost, if you take them for what they say, which you should, they really think they can control it. That's the wild card here, because everybody thinks that you have, the chemistry experiment under control until it blows up. So they think they have, and they do have the tools to fight it. I mean, I would push back a little bit that they can't afford to be late. Sure you can. You can jack rates overnight just like anybody else has in history. Now, do you have the spine to do that because you're going to cause either a recession or a stock market dip? You're going to be put under tremendous amounts of pressure from the talking heads to do something to help the people. They tug at all these emotional strings. The scary thing is, though, from the individual investors, they actually believe, hey, if we see this go from transitory to longer term, we can fix it. Sure, they can, but the destruction and or volatility and or craziness that happens between, oh shit, we missed our point, to, oh, let's get this under control, is going to be dramatic. So we're, like you said, I want to try to provide some value here, but I would focus on very strong brand names with strong balance sheets. Did you see Monster got an upgrade today from somebody? And I just threw it in Capital IQ real quick. I mean, zero debt to worry about, growing earnings and revenue at double digits, 16% this year, I think 10 the next 2 years projected. But when you think about pricing power and just, keep that simple when it comes to those inflationary scares.
Everyone
and then
has
have your hedges
power
in
right now.
commodities.
I mean, it has, everyone has pricing power right now. Everybody that, like, no
Well,
matter
I
what
wouldn't
you're
say
raising
everybody.
prices for.
I mean, I think you'll see that over the next earnings.
I honestly would say everyone.
Yeah.
Because people are not looking at something saying, I'm not going to pay for that right now. They're doing a little bit in housing, a little bit. They're like, okay, let me wait. But when I see
the more that stays with you,
up,
you're going to get to the point where you have to choose between Monster and or another drink. And that's when it's going to come down to, hey, what do you want?
And what do you think the other drink is going to do? So that's what the point is. I just went to go buy a car, and it took me 2 months. I'm not going to tell a story again. You'll listen to the past couple of podcasts, but they bagged me out, and they were raising prices. They were raising their fees. They raised everything, and I had to pay it. If I didn't pay it, the guy behind me is buying that car. I'm not getting a car. I mean, so when you have nothing on the shelves, where you're seeing that kind of massive demand, where they're like, well, we're raising prices because if you're not going to buy, somebody else is going to buy, which means they have pricing power. There's very few companies I've seen right now that don't have pricing power. I mean, Disney might be one of them. They're going to try to raise prices, and I don't think people are going to be too happy because they gave away that service for free to everyone. And, the new content is big, and not spending enough on new content compared to the competitors. But most companies that I'm seeing have pricing power. I just haven't seen anyone that raised prices, and I'm not going someplace because they raised prices. They're still going. Otherwise, you're not going to go out to eat. You're not going to go everywhere. And I mean, I don't know. That's just my opinion. And something else, Dan, I wanted to get into. It does have to do a little bit about inflation. I don't, again, inflation is not always the most exciting topic to talk about, but this is important, guys. This is going to help your portfolio. But did you see the news out of China where they have the virus outbreak? And for some reason, this is under the radar. I mean, this a couple days ago, I started reporting about it. They're not mentioning anything about it. And I'm very surprised because it's significantly impacting shipping already, where wait times for vessels out of Shenzhen went from less than 1 day, and now it's to 16 days. I've been to Shenzhen. Think about the biggest city in America, which would be Jacksonville based on mass, believe it or not. And the entire area is 100% industrial. That's kind of Shenzhen. So just the ports, everything coming out of it, it's where tons of goods are made, especially for the U.S. I mean, this is going to impact so many companies, so many sectors, and I don't think that's being factored in because people say, well, it's only like 2 weeks. No, because stuff has been... I bought a mattress. I bought a brand new mattress, went through the whole system. I said, okay, this is the one I'm going to buy. I ordered it 3 months ago. I didn't get any news on it until 2 weeks ago, and I said, is this like a fraud or something? And then finally someone called me. I said, am I going to have to charge this back or whatever? And just say word charge back. If you ever want someone to call you back, say charge back. Because if you get a charge back, if you get enough of them, your credit card company could shut them down and they can't take online orders. Just mention the word charge back. We know that very well. But, you never want to see chargebacks, right? If someone wants a refund, give them the money back. But they called and they were like, well, it's going to be there. We see the order. It's going to be there in about 2 weeks. And this was 2 weeks ago. But now it could be delayed even longer, right? So we're looking at product delays, which are everyone has experienced. If you ordered like so much stuff, they say, yeah, well, it's not inventory. You'll get it in a month, 2 months, 3 months. Even the autos, it's like 6 months delays to 9 month, 12-month delays. Now, how does this factor into stocks? It's going to cause companies to delay their earnings. They're not going to be getting paid on these orders. You could see more cancellations. And we are pricing in for perfection at all-time highs. Like nothing's wrong. There's no inflation. They have pricing power. Every company's seeing margins explode right now. If you don't have products to sell, that's a pretty big deal. You're going to see that with Ford and GM as the rest of the year goes on. And they kind of warned about it, but they're talking again about the EV market. And there's a reason why GM's not reinstating his dividend, even though the stock's at all-time highs and profits are all-time highs, right? So there's a reason why they're not reinstating the dividend, because they're worried over the next 6 months, and they should be. Now with these delays, you're going to see furniture, housing, materials come from infrastructure, consumer good companies. I mean, this is going to impact tons of U.S.-based businesses, which may force them you'll see them maybe miss earnings and then push out the guidance even further, where they might not even see next quarter, but the further quarter. And when you see delays, or if you see companies miss estimates, especially at these levels and what they're trading at, they get nailed, and they get nailed hard. This is a pretty big story. I think the best way to play it, Daniel, again, we talked about this a little bit, but just look for companies like the largest U.S. importers of goods from China, because they're going to be significantly impacted. You look at manufacturing companies, infrastructure companies, a lot of these materials come out of there. These are major ports. This is a big deal because it is China, and we know that China lies about everything. So if they're saying there's an outbreak and it's 16 days where that's the wait times for vessels out of Shenzhen, it's probably a lot worse than that, and they're not telling everybody, right? Because we all know what happened with China and everything. Now we know, right? We don't have to post that in social media, or you got thrown off. But that's a pretty big story to me. I don't know if you've been paying attention to it. I know we talked about it briefly, but that's something that I think should be talked about even more than this Fed meeting, because we kind of know what the Fed's going to say in a little bit.
Yeah, I did see I saw the headline. I think it was a good CNBC article about the shipping delays and things like that. And I like this, Frank, because I got to tell you, I read that and I went, nah. And here's why. It's a new strain of COVID, right? That's what I took from it, a new strain of coronavirus outbreak. Unless they shut down and do a lockdown or stop, and I know that they've done delays, and it sounds like they've shut down some of the shipping areas, but unless they do something where the interpretation is a lockdown and a oh crap, oh shit moment, I think the market will give companies a pass. And I think that the way you handle that during earnings is, hey, we got delayed because of such and such, but our backlog is at record amounts. Now, I think there's going to be volatility there, but unless the people get word, investors get nervous about another lockdown and then rolling lockdowns that would expand from China like it did the first time, I think the market's going to be a lot more lenient than maybe you do. I think volatility, but I don't think they're going to get hammered.
They could get.
And of course, I could be dead wrong, but I did. I love that because I could tell you were digging into it, and I'm like, here we go, another one of these outbreaks, another one of these delays.
Listen, just say that the wait times went from less than 1 day to 16 days. That's what that reporting means. That's crazy. That's big news, right? That's really big news. That's a big deal, guys.
But the also big deal is, how long does that last? If that lasts a week, that's a big deal. If it lasts a month and a half, that's a huge deal.
That's huge.
You know
so
what I
we
mean?
have to see what happens, and we're probably not going to know what happens, right? Because it's China, and we're really not going to know the data. But will these companies get a pass? I have to tell you something, and being in this industry for 25 years, I think people, even with options, you can throw this at options, which is important, but the value of time, I think people underestimate it. Because saying that, these orders are delayed, and maybe they're delayed for a quarter or a little bit long, the longer you delay, the more you bring in everything possibly that could happen over that time frame, right? It's with options. You could be 100% writing a thesis, but the timing is wrong, and you lose all your money, depending on what options, strategies. But when you say, you're right, maybe everything's okay. But when I see the Fed not raising rates and I see inflation rates going higher, and you may see people pull back a little bit, in pocketbook and say, well, all right, we're not spending too much. We've been spending a lot lately. We've gotten all this money from the government. We're going to see, supposedly, benefits, right, expire by September. So that means, less money going to a lot of people and going to have to work now. So who knows what's going to happen over the next 3 to 6 months. So if this lasts longer, this is a serious story. You got to pay attention to it, and it's going to result in companies Missing earnings. Could they get a pass? Yes. A lot of companies got a pass so far. They've pulled back and then people bought them and they went higher. But this could lead to fewer orders. And, I definitely keep track over this because usually when you see delays, even during earnings, you see a company get hit. It's been common for these companies to bounce back tremendously, like we've seen time and time again. It's turned out to be a buying opportunity. There's going to be a time where it's not such a buying opportunity. And the fact that inflation is going high, the Fed doesn't seem like they're doing anything. I don't know. I mean, when inflation goes high, people are paying more prices. Everything's more expensive than it's ever been. Eventually, they're going to have to cut back a little bit. And who knows? But I just think this is a story that demands attention, and we're not seeing it. And I could be wrong, and I hope I'm wrong on this. I'm even wrong. I hope I'm wrong on inflation because portfolios are going to do fantastic. I've done a lot of research on this. I've studied it because I'm just a data nut. Guys, inflation, man, you guys never lived through it. I didn't really live through it when, during the prime of my career. But holy cow, I hope that we do not have that because I know that 95% of people do not understand how painful it is going to be when you can't get a car loan, you can't get a mortgage, you can't get any money, your rates are going higher. Most people have tons of debt right now. It's not going to be pretty. So I hope that doesn't happen. And that's why I'm a little concerned about the Fed. But this story in China needs a little bit more attention, I think, Daniel. It really does. At least monitor it. If you have companies in your portfolio that, a furniture company that receives 60% of their funds from China and they're getting them in, just be careful because don't be surprised if they miss earnings and say, holy shit, how did that happen? This is how it happens.
Yep.
Okay. So this is a leading indicator telling you that, hey, we could see problems going forward. Monitor it, ask lots of questions, try to go, again, it's not easy to find accurate information on China, but yeah, that story could command some attention. Now, last topic here is the most important, Daniel. By far.
Uh-oh.
I know you're looking because usually we say, we'll talk about this. This one, no, it's not on your sheet.
Not on my sheet. Not a heads up.
And it's the easiest question in the world.
Perfect. I love
Who's going to win the U.S. Open?
Who is going to win the U.S. Open? That's right. It starts tomorrow.
Torrey Pines, right?
Yeah.
I got the winner guaranteed, so just let you know.
Well, I got to go with Koepka because
that's your boy.
He's my favorite.
That's your boy. You love that guy.
And I will go with my long shot would be. So I like one of the pairings. I saw Jordan Spieth, Schauffele, and I forget the third guy in that group. I think those.
Is it Rory? Because Rory had. I think Rory, maybe Dustin Johnson.
But I like Schauffele a lot. I would whatever the odds on him are. I would take that as my dark horse or long horse. What's that term I'm looking
dark
for?
Horse, yeah.
Dark horse. Yeah.
Long shot. Yep. That's
who's your guarantee?
John Rahm.
Okay. Because
he's going to come back with a vengeance.
He's favored, right? He's plus 1,100. I think that's the best.
Is he
odds.
actually favored? Is he favored?
I glanced at it. So.
I just see things. It's almost I see things like this where I've seen Rory blow tournaments like down the stretch and next week come back and win. It's golfers just have that ability to do that when things really go bad. If you don't know about John Rahm, he basically was 6 strokes up going into the last round, and apparently he tested for COVID and he couldn't play last round. So somebody else went to win the tournament. There was absolutely no way he was going to lose it, and they let him know as he was walking off. And the poor guy is like, "Oh my," so whatever.
Yeah.
But you could have told him when he was inside, right? You see the guy go to the floor. He's like, "Oh my," he just played an amazing round, right?
Yeah.
He kicked ass, and you're like, "Sorry, pal, you're out of here." But I just have a feeling he's going to be really, really pumped for this event, and he's playing well. So I think it's going to be John Rahm, and we'll see. It should be pretty interesting. And
happy early Father's Day, because the U.S. Open is always around Father's Day. So.
Yes, it is. Thank you very, very much. Looking forward to all my gifts from my daughters and my wife.
Got to figure out what I'm going to get my dad.
I don't know. Get him like something. I mean, when we went golfing, it was great, right? I mean, it was
probably wait till August and his birthday and just double up. Be like, hey, happy birthday and Father's Day.
Yeah. You know what? I hope your kids do that to you one day too. You'll see. But
the rocks at me, Frank.
Yeah. So I'll probably wind up going golfing or whatever and hang with the family. But yeah, definitely happy Father's Day to everyone out there, guys. And Dan, thanks so much for coming on, buddy. I appreciate it.
Absolutely. See you next week.
All right, guys. Thank you so much for joining us today. Love you guys. If you're on our email list, you probably saw the special offer, Curzio Venture Opportunities, a newsletter, my flagship newsletter. We look at statistics all the time. And a lot of you viewed that promo and viewed it for a while and did not subscribe. And it was basically for 2 reasons. Because some emails that we got, people saying, hey, Frank, I know you're coming out with Curzio 1. That's going to be next week. Which is access to full access membership where, you get access to all products. We publish special deals and stuff that are too small to give to any, we've got it to 3 of these amazing deals in the past 3 months. And you're going to have access to everything we produce in the future. I mean, just worth the price, expensive membership. People are like, hey, you know what? I want to wait because I might just, take you up on your Curzio One offer first. Okay, that was one excuse that we saw. The next one was the price. So this is a very expensive newsletter that we discounted 40% to $3,000. And since we saw a couple people say, price a little too high, this is what we're going to do. There's some people that ordered it at $3,000. If you did, call me and I'll give you a discount. Because we're going to lower that from a 40% discount to a 50% discount, right? So instead of $3,000, it's going to be $2,500. I'm not doing that because we need money. I'm doing that because the ideas that I'm seeing in this space are really, really cool right now. Again, past performance, not an indicator of future performance. I'm not guaranteeing anything, but the company I'm seeing is small cap space, and I know small caps are up, 17% this year. There's a lot of great names that I want to see people get in it. So companies completely off the radar. I know people who structured some of these companies where some just IPO, they merged to form new entities. So you're not going to find them on most screens or any place. And there's a couple of really good names out there that are just trading at prices that if everything goes right, you're going to see exceptional returns. All these are small cap, micro cap stocks. So there's a lot of risk. But you want to make sure that reward is worth it. And the reward has been really, really great from a lot of these names that I'm seeing right now, the potential reward compared to the risk that we're taking, which is usually around a 35% stop that we'll put on these things. So just for you guys, I am going to lower that price because, we like to listen to our customers. Again, it's not to the point where, let's keep lowering it. No, it's not going to get lower than that because it's not worth us selling it lower than that. But we did offer for $2,500 a couple of times, so we're gonna honor that offer. And again, if you're on our email list, you're getting that. If you don't want Curzio Venture Opportunities, don't worry about it. But again, we want to listen to our customers, want to help you guys out. And guys that talked about the Curzio One membership and want to come into the Curzio One, just know that that's an invitation only. You have to send us an email, frankcurzioresearch.com. We only send it out to the people who email us, and usually that's people that own more than one of our products or even one lifetime product to a back end because the deal that we offer is really fantastic. If you are a true Curzio that's going to be around forever with Curzio Research, it makes sense and pays itself off pretty much in 2 years unless you want to purchase all the subscriptions. So if you're interested in that, please email me. I usually talk to people before they actually subscribe to Curzio One. I like to know the person that's coming in because it's a tight-knit group. And also make sure the product's right for you because I have turned down people saying, you're not going to have enough to really invest in certain ideas, and I don't want to just take people's money. So, that's the scoop with Curzio Venture Opportunities and also Curzio One. Expect next week. But if you're going to subscribe, I do because we're going to have it out probably for a few more days, I think, Curzio Venture, and then it's going to go back up to $5,000 a year. So we only discount on products like certain times during the year. So if you're interested, fine. If not, no worries. If you're on an email list, you're getting that offer. If not, you could just go to our website, Curzio Research, and you'll see one of the banner ads there. So enough of that. Want to wish all the dads out there happy Father's Day. Have fun. Enjoy life. Such a great thing. I say that all the time. People complain, they argue, they're pissed all the time, especially, you look at social media, you look at whatever news channel you're watching. Dude, enjoy it, man. Enjoy your families. Have fun, barbecues, have some beers, go play golf. Really, really enjoy it because that's why we do all this stuff, right? We try to make a better lives for our families, and I appreciate all the support that you guys given me over the years. And I just want to say thank you and happy Father's Day. So that's it for me. And I'll see you guys in 7 days. Take care.